Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Tim, the Fed is meeting later this month and also in July. The president has said he believes cutting interest rates will help keep the market afloat. Will they cut rates, and would it make any difference?
Well, I think the rate cuts are definitely coming. We've talked about how, the pressure was on interest rates and that interest rates would be declining and that the Fed follows, actually, contrary to popular belief, and that would be pressuring them to cut. Whether they cut, I track I guess you'd call it a spread. Look at the difference between the discount, the Fed funds rate. I primarily look at the discount rate and the 3-month T-bill. And, there's not as wide a spread there as there was back at the top in 2000 or in 2007. So if they were to cut, it would be a little bit premature, but I do think the cuts are coming. As far as when they do, will it save anything? No, absolutely not. I think that's just confirmation of the beginning of the end when that happens. And, that's based on research and data. There is, and a matter of charts. I mean, it's a historical fact. I mean, if you look at the reality, back in 2000, I forgot what level it was, but I think 7.25%, and they cut down to, I don't remember, I don't have the charts in front of me, 2 or so. And then, in 2007, I think we were maybe around the 6.5 range, and they cut down to 0.5. Did it stop the decline? No, the declines happened. And, I don't know why there's this perception that somehow that stops anything. Now, rates remaining low following the cuts into the 2009 low, of course, that led to the, or contributed to the liquidity bubble and that sort of thing, no question about that. But cutting rates is not going to stop anything. The truth of the matter is, we talk about the big picture and talk about it from a little bit different perspective. The Fed, if you will, the money masters around the world, they've been fighting deflation, I would argue, since 2000. Some would say 2009, but whatever. I would say 2000. And in the process, what they have done is, I know it's been a 20-year period, but and what they have done is postpone the inevitable. But in doing so, they've made matters really worse with the monetary policy because they have created an even larger bubble, but the deflationary forces have not gone away. The inflation is primarily in housing and equity prices and so forth. But if you look at there's commodity prices. I mean, the CRB is at the lower record levels, low levels, and so is there's a Bloomberg Commodity Index, and it's I think it's at 1998 levels is from what I remember, which was, if you recall, was back when crude oil dipped down around $12, $13 or less, maybe it's $10 a barrel, something like that. And so the deflationary forces are still alive and well, but what the bubble has done, or what the liquidity practices have done, is created a bubble in other areas, and now we're moving back into a rate cutting cycle, and that puts us in a I guess you would say a window of extreme vulnerability to me for the markets. And I don't think it's going to save anything. No.
Why do they always go through the same moves? And Bob Hoy, who is a market historian, said since the Fed was invented back in the early 1900s, there's been something like 19 recessions. They haven't prevented anything, even though they were invented to prevent recessions.
I know. I don't. I mean, I think it's a perception. I mean, everybody looks for daddy to fix everything, right? And I don't know. I mean, it's a simple matter of history. You look at the data. I don't know how else to say it, but the Fed follows the rates. Now, sure, they can influence the short end by talking them down to some degree and influence them, but ultimately they follow. And that's what I'm saying right now is that the pressure has been on interest rates, and it's going to force them to cut. But as far as saving anything, he's right. That's what I'm saying. I agree. It's not going to work. And this is a little bit different than the downturn. What downturn there was to it in 2015, 16. We were the rates were moving up then. Well, rates are moving. Pressure is on rates now. This is more like 2000 and 2007. And like I said, the deflationary forces are still there, which is what they've been fighting for 20 years. And now here we sit at the top in the process of fighting those forces. They've blown us into the biggest bubble ever. And the stock market's at virtually all-time highs. I mean, we've been in this topping process for since 2018, and now here we go into another rate cutting cycle. And historically, if you look at the data under the microscope, that's not a good thing. It puts us in a window of vulnerability.
Well, what is cutting rates supposed to do? Why is it supposed to stimulate things? And also, this time is different in that there's so much more debt now than there was the last time they dropped rates.
That's right, and that makes it even worse. The debt saturation, if you will. I mean, that's a huge problem. As far as cutting rates, of course, I guess the thought process that is sold to the public is it's liquidity, and it'll keep the markets liquid, stimulus, whatever. But like I said, it's a matter of I love controversial subjects, because people, they think the Fed sets the rates and it's a matter of overlaying two charts and looking at it in a spreadsheet, and they follow. And so I don't know that they're going to cut in June. Maybe. Looking at the spread now, it would be premature. Depending, I don't know. I mean, I wouldn't, looking at the spread and the historicals on that, I think it would be premature, but, maybe. I think we see a cut in July, probably.
We'll have more with Tim Cyclesman Wood right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, a couple of oil tankers were attacked off the coast of Iran. One of them caught fire. They said that's the reason why oil prices went up today, but is that enough to sustain oil, and what do your charts tell us about crude?
Well, there is we've been rolling over. Let me answer that kind of a long. I'm glad you brought that up. I had just heard about that. I hadn't had a TV on, and something popped up on the computer. I just heard about that minutes before we came on. But no, it's not going to. It's not. I don't think it's long term. Going to have a long term sustainable influence on oil prices. And the reason I say that is that within the context of this ginormous top that we've been talking about forever now, is that now we're seeing data where we're rolling over this raw materials data that I track, and I've done some extensive studies on that in the research letters to substantiate what I'm saying. But there's hard evidence that we're rolling over out of the sixth economic top or sixth inflationary cycle, or however you want to look at it, since 1800. And if you, like I say, it's a matter of just overlay two charts. And what we've seen is that, or what I'm seeing is that, crude oil follows pretty much this raw materials index that I'm tracking. And the raw materials data it's broken down. It's not breaking down, it's broken down. And so that tells me that, the die's pretty much cast. And knowing that crude oil has historically followed it very, very well, it tells me crude oil is going the same way, which is what I've been saying all along. Granted, we had that intermediate term rally, but I think that's over. I think anything here is probably noise. If we were to see a spike up from some sort of a fear like that, I think it's temporary because that data is rock solid. And I just know crude oil is going lower.
Tim, with lower crude, what does that do for other products that use it? Does that bring their prices down as well?
Of course it does, but what it's also reflecting is the deflationary forces that are trying to take hold. That's what it's showing us. I mean, it's one measure of it, if you will. It's a symptom of those deflationary forces, and that's what I'm seeing. Like I said, in all these commodity indexes, and the thing that is lingering, that is not cracked yet, that's been trying to set up for over a year. I mean, it started in January of 2018 at the top. The equity top back then. That's when we started seeing all the leadership. Remember last year we talked about how the leaders were of different indexes and averages and sectors were leading the decline and leading that setup. And when then it finally resulted in that little decline, we saw, a little scare into December, and now we've rallied out of that. And so equities are kind of, I used the word last year, camouflaging, and they are. They're camouflaging this setup that is taking place, this ginormous rollover, and equities are still lingering there. So anyway, long story short, I think that crude oil forgot my train of thought completely, but I think crude oil is reflective of those deflationary forces that are trying to take hold, and I think it's going to spill over into everything. Absolutely.
Going back to interest rates and how they're supposed to stimulate things. Well, for example, when house prices start to fall like they have in Canada, although interest rates might come down, you can't take advantage of them because banks are a lot less likely to lend to you because they're scared they won't get their value back if you default on your loan. So in fact, it doesn't stimulate. The banks actually get stingier with their money. Is that a factor?
That is a factor. Yes, I mean, you do see that. I mean, when the economy falters and times get a little tough, the banks tighten, and so yes, that's, like you said, they get stingy. Absolutely, that's a factor. So you're right. The other thing, talking about interest rates, the other thing I've been watching is some of these spreads. People talk about, well, you're not in a, well, I don't want to put words in anyone's mouth, but remember back in 2000 and 2007, what a lot of people look at is the inversion of the yield curve. And they say, well, the yield curve has to invert before, we have a market top. And, well, that's not exactly true either. When you really look at the data, what you see is it may invert in the process of moving down, but it doesn't have to invert. It's the reversion back up, when it turns back up that is the problem. And the first canary in the coal mine there is one of the spreads that I've been watching, and it turned back in last July. And so it's been warning, and now waiting on, there's another one that I'll watch. It hasn't quite turned yet. I think it's coming. It's setting, I think we're getting real close to that. And so everything is lining up. And then when you start looking at, you overlay and you start looking at the, where the rate cuts come, which, like I said, I think they're coming. All of that is symptoms of deflation. It's not inflationary, it's deflationary.
We'll have more with Tim Cyclesman Wood right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, a lot of people feel if the stock markets start to fail, people will turn to gold for security. Is that a fact?
No, I don't think so. I think that's another myth. When this thing finally goes, I think liquidity is going to be key, and anything and everything will be sold. Gold didn't. We may get a pop. We've had a counter trend rally here. Gold is really just kind of flatlined. I've said that we had the 9-year cycle top. I stick to that. We may retest it a little more before this is over with, but it's not really going anywhere. I don't think. If we see a pop, I think it's noise. And you look back to 2008 and 9. That was arguably. Not arguably. It's a fact that it was the worst financial crisis since the Great Depression. And what did gold do? It went straight down with everything else. And so, I just don't, I realize gold is money. I don't need hate mail on that. I get it. I understand. We should be on a gold standard and a gold back. I get all that. But in the deflationary environment, it's not going up. It's going down or just, kind of hold in here like it has been. But I don't see it as some great hedge. No, I'm sorry. I don't see that.
Any outlook for the U.S. dollar?
Well, yeah. Still positive. We had the lows back, lost track of time now. I think it was February of 18. And we've been, very positive on the dollar ever since, and I'm still positive on the dollar. Now, that said, there are some relationships that I have noticed, or I say noticed, been aware of, but recently talked about, where when you go into a rate cutting cycle, it can have a tendency to put a cap on the dollar. Sometimes it's a bit of a lag before that happens. In other words, it's not just instant. So I think as we move into a rate cutting cycle, it could soften the advance in the dollar, but until I see something, technical to say that it's topped, I'm still pretty positive on the dollar as well.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.